and welcome back. For those of you that have not been here before, what I talk about on this channel is everything to do with education, lifestyle and finance. Today I'm going to demystify, and I'm just going to get on with it because I know from watching a lot of videos that having a long intro can be quite frustrating. But I'm going to get on with it and I'm going to demystify what investing actually is. As an educator myself, someone that works in secondary schools, I know that investing and finance really aren't taught in schools. So otherwise, how are you supposed to get this information? We've all heard about the stock market, and most of us have heard that, oh, you can lose money on the stock market, and then we leave it at that. And that was very much me. I am extremely new to investing. It's something that I've been looking at for a few years now, but with this pandemic that's been happening and the interest rates in the banks being 0.01%, it really did push me into the investing field. But as I say, I have been looking at it for a good few years. So how do you know if investing is for you? Investing in the stock market, that is. If you're looking at investing for the short term, and I mean you need your money like tomorrow or next week or even 2 years down the road, then investing in the stock market is not for you. It really is a long-term thing. So if you're wanting short-term cash, keep it in an instant access savings account if you need that money for something more immediate. For the stock market, I'm going to explain the different types of investing that you have. Now, as I say, it is a long-term strategy. You're looking at investing for 5 years at plus. Some people have got their portfolios and have had their portfolios growing for the last 25, 30, 40 years. Having a portfolio is like running a business, so a portfolio of stocks. So when you're investing in a business or building up a business, you are not going to leave that business after a year, 2 years or 3 years. You're looking at the long term, and that's what it is with investing in stocks and shares. I'm going to try and explain this in a very simple way. So you have one type of investing where you might invest in the individual stocks. Now, this is what people say is risky, and this is where the risk is seen in individual stocks. So if you're going to buy a share in a company, for example, and you're buying that share for, I don't know, let's say £400, you buy that share for £400, then a month later that share drops and you're left with £200 of that share, then you've lost a lot of your money. And then you've just got to wait and see if it's going to pick up, if you're investing more, and if you're continually investing or pick up over time. So that's one way of losing it. But then if you're talking about bigger amounts of money, like 12,000, 16,000 in one particular share, then it can become quite scary when you see movement in your portfolio, like the movements that we have had recently in April, where where nearly the whole world has gone down on a lockdown and markets have literally gone down, and we saw that dip in the market. The other type of investing that you have, which is seen as a lot safer, and it's what I've been doing and investing my money in, is where you invest it into index funds and ETFs. Now, this sounds like a very complex word for those of you that have never come across this, but it's quite simple really. Just think of it as a basket of apples. So you've got a basket and you've got lots of different companies in that particular basket, or you've got lots of different apples in that basket, but the apples are different companies. So your money, instead of going into the one stock or the individual stocks, like when you're choosing your stocks independently on the stock market, if you put your money into an ETF or an index fund, then your money and the risk is being spread across a lot of different companies. These ETFs tend to track or follow the top companies, blue chip companies that are in each individual country. So you'll have the S&P 500, which is for the USA. Then you have the FTSE 100, which is for the United Kingdom. So in those FTSE 100s and the S&P 500, you'll have large IT companies, large pharmaceutical companies. So think about Microsoft, Amazon, Apple, those type of companies. Now, if you buy into a fund, and there's lots of different funds that you can invest your money into. You can invest your money into an emerging market. You can invest your money into, let's say, the Asian market. You can invest your money into different funds. Then the risk is spread and your money is spread across those funds. Also, you tend to put in a smaller amount, invest a smaller amount. So some companies ask for a lump sum of £500, and then here in England, and then you can invest as and when you want. Some other companies ask you to either put in £500 or a direct debit of £100 per month. Now, I have been investing and seen my portfolio, and I've seen rises and dips already, but I've still at this moment in time haven't lost any particular money in those funds. But your money you can go down to a negative where you can lose it. But literally, I've seen over the past few days, I've seen a growth of £4-5, which is a lot more than what I would have seen if it was in an instant access savings account. Now, what is the point of investing like this? Why is it that people invest in this way? They do it for financial freedom. Now, there's a big movement at the moment where a lot of millennials want to retire early. Millennials are wanting to retire at the age of 35, 40, 45, and this movement's called FIRE. Some people are investing into stocks and shares because they want to live off the dividends. Now, a dividend is where a shareholder is paid a profit. So when you invest into a company, say for example you're investing into one of the big IT firms out there, every quarter or year, depending on the company, and not all companies pay dividends, will pay you a share of those profits. Now, the more shares that you have in different companies, or the more shares that you have in a particular company, the higher your dividend. Now, some dividends could be paying something as minor as small as 12 pence, but that all adds up as your portfolio grows. And then some people might, and they can see a massive growth within a few months, where they're building up to £200 a month being paid in dividends. Now, some people use the dividends, especially when they retire or retire early, they use those dividends to pay off their expenses. So we're talking about your electrical expenses, maybe your mortgage, your shopping bill. Those are the expenses that they're living on. You can also, if you want to, reinvest your dividends, which is what I'm doing, reinvesting it, because I don't really need to live off those amounts right now, because I've got a full-time job and they're too small for me to even bother about at this moment in time. Also, they can be tax-free under a certain amount, but over a certain amount you do need to fill out a self-assessment form, which is quite tiresome, which I've done before for a number of years when I was self-employed. So for now, it's really easier for me just to have that reinvested, because I'm looking at the growth, the capital growth of those particular stocks. And that's another way of doing it. Some people are either looking at the growth and the dividends, or some people like me right now are looking at the growth and just wanting to build that portfolio for the future. And what we mean by growth is when you are getting a percentage, an interest percentage, for example, like 5%, and it's making 5% a year, you can have compound interest with this. And then when your dividends are being paid back into the company, then it can grow. So for example, with $2,000, say $2,000 over 5 years, with a 5% compound interest, you could be making £566.72 5 years down the road. So on that particular stock, if that's how much you've got there with compound interest, bringing in that amount of money. With the ETFs and the index funds, the sort of percentages that you're looking at to make your returns on are 8 to 12%. That is a really, really good return. Those are some of the returns that we've seen in the past. Also, bear in mind when you are investing, you can't look at the past to predict the future, because we could never have predicted what has happened at this moment in time, could we? Everything is really up for a question mark when you've seen what's happened this year, for example. Now, there's a lot of you out there at this moment in time that have money just sitting there, and a lump sum of money just sitting there, and you're thinking, oh, what shall I do? Shall I invest? I would say no. Don't just throw your money at investments without doing your research. Just because your mother's brother's son told you to invest your money doesn't mean that you should invest your money if he's never invested his money before. You need to research and do that due diligence. You need to know who's sitting on the boards, what are their future plans, how much money have they had coming in before in the past. Is there any predictions for the future? Are they going to make acquisitions, join other companies? Is there anything you can foresee? Like, for example, me thinking off the top of my head, Cineworld's been closed for a while. So I'm assuming that sooner or later those stocks are going to be rising, because I looked a few months ago and the Cineworld stocks were about £30. Now they've risen to £70, maybe because they're releasing movies online. But then when they do open, people are going to be going to Cineworld, so the Cineworld stocks will rise. That is my prediction. But we don't really know what's going to happen in the next quarter coming up, because bear in mind, nobody can predict the future. So that's just a little snippet, and I hope that it's helped on explaining about investment funds. Please do smash that like button because it really does help, and don't forget to subscribe.